welcome to a new topic. Today, we're diving into the world of sovereign wealth funds, the state-backed giants reshaping private markets. First, let's understand what sovereign wealth funds are. Sovereign wealth funds, or SWFs, are state-owned investment vehicles that manage national reserves for various objectives. These funds are typically fueled by sources such as oil revenues, trade surpluses, or foreign exchange reserves. They are typically structured as stabilization, savings, or strategic investment arms, each with a distinct purpose. There's a key distinction between stabilization funds and savings or investment funds. Stabilization funds are primarily used to smooth government budgets, particularly during periods of commodity or market volatility, acting as a buffer. On the other hand, savings or investment funds are focused on long-term wealth preservation for future generations, aiming for sustainable growth. A prime example is Norway's government pension fund Global, which serves as a leading model for savings funds. Now let's explore why sovereign wealth funds choose to invest in private markets. One major reason is their ability to provide patient capital, free from the short-term redemption pressures that often affect other investors. SWFs also aim for higher risk-adjusted returns compared to traditional bonds or equities, seeking more lucrative opportunities. They gain access to innovation, critical infrastructure, and long-term growth sectors that may be less accessible through public markets. Investing in private markets also helps them hedge against oil price volatility or other commodity cycles, diversifying their risk. Their long-term outlook means they can commit capital for extended periods, aligning with the growth cycles of private assets. This approach offers diversification across various asset classes and supports higher return targets, bolstering their overall financial strength. The biggest global players include GIC, Temasek, ADIA, Mubadala, PIF, and Norges Bank, each with significant influence. SWFs employ diverse investment strategies, from direct investments to co-investments and GP fund commitments. GIC, Singapore's SWF, boasts a highly diversified global portfolio spanning private equity, real estate, infrastructure, and credit. Temasek, also from Singapore, strategically focuses on cutting-edge sectors like biotech, AI, and next-gen technologies. ADIA, based in Abu Dhabi, is one of the world's largest SWFs, with a strong emphasis on private equity and real estate investments. Mubadala, another Abu Dhabi fund, makes strategic investments in key sectors such as aerospace, semiconductors, and healthcare. Saudi Arabia's PIF is highly active in disruptive technology, major sports ventures, and global megaprojects, driving economic transformation. Norges Bank, Norway's SWF, is the largest globally, renowned for its strong ESG focus and significant influence in public markets. Let's look at the inherent advantages of sovereign wealth funds. Their immense scale and deep pockets enable them to enter mega deals that few other investors can match. SWFs forge crucial global partnerships with private equity firms, infrastructure funds, and leading corporations. They also offer remarkable flexibility in structuring deals, ranging from minority stakes to complete control buyouts. Many SWFs play a strategic role in national development and economic diversification, supporting long-term growth. However, SWFs also face unique risks and challenges. One challenge is the potential for political influence in their investment decision-making processes. Transparency can be a concern, as not all SWFs publicly disclose their complete holdings, making scrutiny difficult. Concentration risk can arise in certain sectors, especially for oil-funded SWFs tied to energy cycles. They can face significant geopolitical scrutiny when investing in sensitive sectors such as technology or defense. Looking ahead, sovereign wealth funds are set to play an even more prominent role. SWFs are poised to play a much bigger role in private markets as traditional capital faces increasing constraints. Expect to see more investments in technology, climate solutions, and sports as diversification accelerates across their portfolios. Rising geopolitical competition, particularly between the US, Middle East, and China, will significantly shape future allocation trends. We are also likely to see an increase in public-private partnerships, especially in critical sectors like infrastructure and green energy. The ongoing impact of sovereign wealth funds on global deal-making is undeniable and will continue to grow.